Okay, so last week I lost out on actually a pretty big deal. I'd spent a lot of time on it, and I thought, you know what? Initially, I didn't want to talk about it at all, but I was listening to a podcast last week where one of the guys was talking about sharing the journey and how maybe other people would find that valuable. So I thought, you know what? What the heck? I will tell you about the deal, some of the mistakes I made, what I would do differently, and yeah, just if it resonates and it's what people, if it's other people are interested in kind of hearing about my mistakes and how to avoid them, then it might be helpful. So this was it was about 15 acres just south of Phoenix. I don't want to get into the details because it's under contract and I probably have information that is still quite private. And who knows, the deal may come back. But long story short, it was about 180 units when the whole thing is built out. And I liked it. It had been on the market for quite some time. I want to say I saw it initially 8 months ago. And for whatever reason, it just, I had too many other things on the go. So I didn't pay enough attention to it. And then my broker came back to me and said, "Hey, Shane, I think you should look at this deal again." So I did. And I started to really dig into it. And there was a couple of things in any kind of a real estate deal. There's always like a few things that I'm looking for. And in this case, I was looking for the gap. And what I mean by the gap is like, why should I be doing this deal? I guess that's probably the best way to put it. Um, no one's bought it. Here I am up in Calgary. This deal's in Phoenix. Phoenix is a hot market. Why hasn't anybody else closed it? And so that's kind of the first question that I asked. And then I started to kind of dig into it. And my initial thoughts were, you know what, the product is wrong. If what you're telling me is that the vacancy in this submarket is kind of 1 or 2%, then why are the rents so low? And as I started to dig in, I realized that when you build too big a product, people could only afford so much. And in fact, the demand was for smaller units. And so once I realized that that was, call it the gap or where the opportunity was in this deal, I really started to dig in. And so what that meant was I started to line up investors and I started to put together my presentation. So not last weekend, but the weekend before, because it was Thanksgiving long weekend here in Canada. I woke up on Saturday about 5 a.m., worked for about 3.5 hours, and that was, call it, my one pager. Now that one pager turned into about 5 or 6 pages, but there was a lot of kind of pictures and addendums and whatnot. But really, the nuts and bolts of that deal, I was able to compress into one page, and that's what I was going to send to my investors. On Sunday morning, woke up the same time, 5 a.m., worked till about 7:30, 7:45. And that day, I worked on the financial analysis or underwriting. And the underwriting was really like I had to make sure that the numbers made sense. And when I first went through it, see, one of the tendencies I think people have when they do underwriting is to what's called like financially engineer development, because it's very easy to tweak cap rates or rent per square foot or density or costs. And even if you're just even if you're just kind of tweaking things like 5%, 10%, what happens is over a big deal, you do 5% here, 10% there. Um, Eventually, you can turn like a deal that maybe is marginal to making it look unbelievable. And so, what I wanted to do was really make sure that I wasn't BSing myself into a development that wasn't going to make sense. So, I spent some extra time. I did the research. My broker did a tremendous job on it. And so, what I had was a very clear picture of both supply and demand. And once I had those two pieces, then the last part of the equation, like, so kind of, is there demand? Yes, there's demand. What's the supply? Okay, there's a gap in the market there. And then the third piece that I looked at was what was the risk? And what I mean by risk is like, in this case, because I'm in Canada, this deal's in Phoenix, it's a development. I know that there's going to be some inherent risk. And so the question I needed to ask was, how do I mitigate that risk? How do I prevent or eliminate some of the like major pitfalls? And so what I did is I started to line up general contractors that had experience, trust, subs meaning sub trades, people that could actually do the work. in these markets. And, at the end of the day, I submitted a letter of intent Monday morning, sent it off to the broker. Broker gets back to me pretty quick and he says, Shane, you realize that you're not going to be closing until 2020. And I said, yeah, I know that. And he says, well, I thought I kind of told you that the vendor in this case, like timing is extremely important and they want to close by the end of the year. And I said, well, here's the challenge that I've got. Number one, I'm up in Canada. Number two, I've got to get my money down into the US and I've got to do due diligence. I mean, we're running into US Thanksgiving and Christmas. I've done deals over this time period in the past and I know it's going to be tight. So I don't want to put myself in a situation that's going to be where I'm going to set myself up for failure. So I said, look, I'm not going to negotiate with myself. Submit the offer. I've got room on both price and timing, but I want to find out what is more important because my price was a little bit lower than what they had asked. So I knew I had two variables on the negotiation, if you will, terms and price. And I wanted to know where I had a little bit more flexibility. Anyways, about 3 hours later, I get a call back. Shane, the deal's gone to someone else. And I was like, really? And I said, so what was do you know any details? Without giving it away, basically they came in at full price. I was probably 10% below. And they were able to do their due diligence in about a quarter of the time. And so I looked at that, had a short conversation, hung up. I was very upset. I don't want to say on this podcast some of the words that I used. And I kind of went for a run and I thought, you know what? I got to do a bit of an autopsy on this deal. What did I do right? What did I do wrong? What would I do different? And at a very high level, I wrote a post about this on my website. So you can kind of see a bit of I don't know what you want to call it, but you'll be able to kind of see a detailed breakdown, but I'll give you a few things. So number one is this deal, because it was cross-border, the timing was going to be more challenging for me. And I know that. I thought because this market was what I consider to be stale, meaning it had been on the market for a long time, that it was going to buy me time. Number two, I didn't really listen to the broker as well as I should have. He told me that there was more interest. I thought that interest, I didn't take the time to actually call up both my broker and the listing broker to find out what that interest meant. Had I known that the offer was going to be like very tight on due diligence and the price was going to be as high as it was, I certainly would have adjusted my price, but I probably, the timing, I just wouldn't have been able to match that buyer. And I don't know, but I expect that investor that got the deal is local. And I'll tell you why I think that in a second. Because through my due diligence, when I was putting together my one pager, I came across an article that had just said there was a new company. Now this company had been in the works for about 5 years, and they were going to build a new plant that was going to employ about 1,000 people immediately, and then about 2,500 jobs down the road. When I saw that they had got green lighted and they were rolling dirt, I knew that project was a go, which meant that there was going to be obviously, construction workers that were going to be working there. But then the long term was these kind of 1,000 new jobs. And that had literally been probably 5 days prior. I saw that article and I realized that afterwards, I didn't realize it, hindsight's much easier to kind of think about, if you will. But I realized afterwards that once that project got green lighted, all of a sudden there was just an inflow of investors, because now that there's going to be a demand. Before we thought there was going to be demand. Now, once this project got off the ground, we knew that there would be demand. And so that was something that I probably didn't factor in enough. And so, didn't listen to the broker. I didn't, what was the second one? I didn't confirm up front with the broker, the listing broker that is, on what the other offers look like. They're never going to tell you what the offers are, but they'll guide you. And that's really what I should have been asking for. And that was my fault. And then really just the cross-border and the fact that I wasn't in that market. So those are the three things that I kind of screwed up on. what I think I did right, because on every deal you can look at it, and there's no need in kind of beating myself up because, frankly, I think that there's some things I did right. The first was I was able to really streamline this deal because it was such a big deal. I was going to have to raise about $6 million in equity, U.S., and so as a Canadian investor, that number is probably close to 8 million. Um, I needed to feel very comfortable. I don't want to submit an offer and then, especially on a deal that size, like I kind of know what my bandwidth is, and this was pushing up on the upper end of it, especially because it was in a different country, different market, and all that stuff. So what I wanted to do was have a high level of comfort from my investors that they were going to be with me on that deal. So what I did is I put together the one pager and then I did the financial analysis. And what was interesting is I was like, okay, well, I need a model, if you will, on what other deals I've done in the past. So I was like, okay, well, I'm gonna, I was kind of thinking about it, and I was like, oh yeah, I did that deal in Banff that was 20 units. I didn't do the deal, but it was a deal that I'd worked on. And I was like, oh, and where did I get that information? Because I needed something else. And it was like, oh, the 1,150 acres I did in Muskoka. Yeah, now that I'm going to use. And then I was like, well, where did I need a, basically I needed to, it's not a Gantt chart, but basically I needed a timeline on development and absorption. And so I also used a project called Falling Waters out of Palm Springs that was back in '08. So I had like a whole series of deals that I've worked on and been involved in since '08. So what is it, 19? So that's 11 years ago. But because I saved them, I categorized them, I was able to go back and pull what I needed. And what would have generally taken me, could have taken me 30 days to put something like that together, I was able to do in 3 mornings in kind of 3 hours each morning. So I did that right. The second thing I thought I did right was I confirmed the demand. I really got to the essence of how this deal was going to make sense. Um, I mean, I was happy that I was able to understand it in a very short amount of time, uh, confirming the demand, confirming the supply, and then, like I said, mitigating the risk like I thought I had organized. However, I wasn't fast enough, and I really didn't pull the trigger like I should have. So, knowing that, there's a few things that I'm going to do differently. About 3 days later, the broker called me up and he said, "Hey Shane, just so you know, there's kind of a different way of approaching real estate deals down here." And I said, "Yeah, I get that." And I said, "Well, what did you have in mind?" And he's like, "Look, I'm not going to tell you what to do, but sometimes what happens is you've got to play the game. And the game basically is you come in with an aggressive offer that you probably know that you're not going to be able to live up to on price and terms, and you get control of the deal because that's key. If you don't have control of the deal, then all the other work I did was a complete waste. Now, it's not a real waste because the deal might come back, or I may be able to push it onto another deal." And I said, Tom, I appreciate that. And but the truth is, you know me. I said, I'm not going to go into a deal that I don't feel that I can do, because I don't like it when someone ties up my properties and then either drop closes me or changes the terms of the deal. And so if I don't like it, then frankly, I'm not going to go into a deal with that mindset. Now, in some cases, if I find something out during due diligence that requires me to renegotiate, hey, that's part of it, because sometimes the vendor's not going to give you all of the information up front. You're going to discover that through due diligence. But I don't want to go into a deal and violate kind of what I believe to be, super important to me, right? I'm not going to go in there and offer, call it $5 million, knowing that I'm only going to pay him 4.5, because, well, there's lots of different reasons. Obviously, your integrity is one, but even just from a practical standpoint, if you're going into it with that mindset, what happens when you spend $30,000 at due diligence? You go in and try to drop close. They've got backup offers, and you're getting squeezed. To me, it's just a recipe for failure. So there's obviously the ethical perspective, but then there's the business side of it as well. You'll see some very big companies, they can get away with it because to them, $30,000 in due diligence, it's a drop in the bucket. It's just the way they do business. And I'm not here to say right or wrong. I'm just telling you that that is, that's part of commercial real estate, quite frankly. So anyways, I'm not suggesting that in this case my principles got in the way of me doing a deal, because the offer and and the buyer that came in on this property, I suspect that they probably had inside knowledge, which is completely possible, and quite frankly, they should. If they're in that market, they should know more than I do. And good for them. Obviously, not happy about it from my perspective, but that's commercial real estate. So I thought today I would show you sometimes what happens in commercial real estate deals. You got to play the long game. I might do 1 or 2 deals a year, but they're big enough and they make enough sense that I can strike out on 10 or 15 other ones. And I know I don't talk about them very often because, quite frankly, I try not to remember them. I try to have a bit of a short memory. But yeah, that was my last week. Now I've got another deal. I'm not going to talk about it too much because my offer went out last week. I've got another deal. I'll probably be talking with the broker here in the next 15 minutes. And we'll see. So that's the reality of investing. There's always going to be new opportunities. I can't focus on ones that I've lost because, frankly, I can't change that. And who knows? Maybe it's for the best, and it'll work out on these other ones. So that's it for today. What can I tell you? I mean, if you want a copy of my book, Club Syndication, you can go there, download. This week, anyways, I'm going to keep up that website where you can download a free PDF copy, clubsyndication.com. Yeah, and if you have any comments, questions, thoughts, if you enjoyed this podcast, let me know. Leave me a 5-star review, and I will do hopefully not too many more of these. But the reality is, deals fall apart, and so it's quite likely that there will be more shows on my journey where deals don't come together like I would have liked. So that's it for today. We'll speak to you next week. Later.